the sovereign debt thing just keeps on ticking away, getting worse and worse. The U.S. deficits have not really been solved. The DOGE program that Elon is trying to enact with the government, he even admitted the other day that, they're going to have a hard time saving $150 billion a year. And when we're running a deficit, the deficit run right now is in the $2.2 trillion per year area. 150 doesn't, everybody's seeing, I know I'm seeing, we talked about this as well. It's just the relentless bid in gold. I mean, it's, gold is up 55% in the last year. And, every morning I wake up and there's a new all-time high. And to me, what that tells you is the market is saying we are losing confidence in sovereign currencies. We're losing confidence in the ability of these governments to balance their budget, and since they're unbalanced, we believe that they're going to debase the currency to make payments. And that's what gold is saying loud and clear.
LawrenceLepard, a longtime investor and staunch sound money advocate, is sounding the alarm on the relentless deterioration of sovereign debt markets and what it means for gold, silver, and Bitcoin. If you've been wondering why gold keeps hitting all-time highs, Lepard has a sobering answer. The market is losing confidence in fiat. In a recent conversation, Lepard laid out the issue in stark terms. U.S. deficits remain out of control, costing around $2.2 trillion annually. The bond market sees it, and so does gold, up 55% year over year. According to Lepard, we're witnessing a relentless bid for tangible assets because markets understand what's coming. Currency debasement on a massive scale. Lepard also explains the dollar's weakness in context. Since all global currencies are fiat, comparing them is just a race to the bottom. But gold and Bitcoin aren't fiat, they're finite. And that's the real cross-market signal that matters. As trust fades, a Gresham's law dynamic kicks in. People will spend weak currencies and hoard strong ones, meaning more capital flows into sound money assets. He doesn't stop there. Lepard believes the Fed will be forced into another round of yield curve control. If Treasury yields breach 5%, expect intervention and more money printing. And that moment, he warns, is historically when inflation psychology flips. Now, we present the latest clips of LawrenceLepard's video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Dollar is a funny thing because it's measured really in all the other fiat. I mean, all the currencies are fiat, right? There's nobody who's on a sound money standard right now. So you're measuring the euro fiat against the British fiat, against the Chinese fiat, against the American fiat. So I think the American fiat, if you look at the income statement and the balance sheet of most of those countries, I think the U.S. is just demonstrably in worse shape than all the others, but it's been the reserve currency, so it's enjoyed a premium. I think the dollar has a long way to fall, and I think all of those currencies. I mean, what they represent is they represent currencies, things you can buy things in. Everything's priced in dollars. You can easily do a dollar price of anything, as you can with a euro, and the FX markets are very efficient, so you can move from one currency to the other. So to me, how the dollar does against the other currencies, I think it'll fall because it's overvalued compared to the other currencies. But what really matters is not that cross. What matters is the cross between the dollar and gold, or the dollar and Bitcoin. I mean, I think, look, Bitcoin does not have, and gold, there are mechanisms for doing it. I just heard about one actually in Britain that was pretty cool, for kind of keeping, Bitcoin in your account, or gold in your account, and then paying for things in dollars or pounds. But because switching from one to another is not hard, but most people have, currency accounts based on their local currency, and they pay for things in their local currency. And I think what will happen is kind of a mass version of Gresham's law, which says that people will, yes, you'll continue, the dollar will be around, we'll keep paying for things in dollars, but that won't be, nobody in their right mind will ever leave anything in dollars for very long, because they'll know that they're melting, that they're losing value. And so to the degree you get paid, or you have some savings, you'll instantly convert them into something that won't melt in value, and that's Gresham's law. The sound money, the bad money pushes out the good. People spend the money that's bad, the fiat currency, and they save in the money that's good, silver, gold, and Bitcoin. So, that to me is what's going to happen. But we're going to have a much more multipolar world, Kai, and I'm all for that. I mean, I think the U.S. has abused its privilege as the world's reserve currency. It's allowed us to conduct wars, do a lot of stuff that made no sense. So, having a more balanced regime of lots of currencies, and then with gold and perhaps Bitcoin as being the neutral reserve currencies, that'll be a better world, in my opinion. I mean, I think what you're seeing is at least the red team of America realizes that digital assets are important, and that leading in digital assets is important, and that the United States should be aggressive about leading in digital assets. there's a guy named Jason Lowry. He's a major in the Air Force. He's now in the Pentagon, who wrote a book about this and basically said, it's going to be important as a sovereign nation that you have a strategic reserve, just as the U.S. has a strategic gold reserve, or I should say theoretically has a strategic gold reserve. We don't know if it's really there. The country, any large country should have a strategic Bitcoin reserve. And I believe that to be true. And so, whether the Lummis bill passes or whether they're actually able to start buying Bitcoin, it's unclear. Excuse me. But I think that just the fact that we have a reserve and have announced that we view it as an important thing is a positive. And honestly, I think that if you think about it from a game theory point of view, I mean, it's very clear to me that China has made a bet on gold. Those of us in the gold world know that they claim reserves of 3,000 tons or slightly less, I think. But in fact, we've looked at the shipments from Switzerland and other places into China, plus what they mine locally, and we know that they hold much, much more than that. And they have a huge affinity in their culture for gold. And so to the degree that we see all the fiat currencies failing, I think there's a chance that China would make the bet, okay, well, let's solve that by going back to the gold standard. One way for America to perhaps leapfrog China and say, well, yeah, that's great. You guys can go to the gold standard, but that's old stuff. We're going to put our currency on a Bitcoin standard. And which I know sounds crazy and outrageous right now, but I don't think it's as crazy as it sounds.
Lepard digs deeper into what he calls a currency confidence crisis. The core issue isn't just inflation, it's systemic fragility. As the Fed fights rising unemployment and falling markets, it will face a painful trade-off: fight inflation or save the system. Lepard believes they'll choose the latter, every time. He warns that yield curve control is next. If 10-year Treasury yields push past 5%, the Fed will likely intervene by printing money to buy long-dated debt. That's the same playbook from Japan. And once they start, they can't stop. That's why he tracks not just gold and Bitcoin, but especially the 10 and 30-year Treasury yields. To him, that's the real signal. And here's the kicker: anything relying on trust in fiat, reprice, but gold, silver, and Bitcoin surge. This is the psychology pivot. The moment when they can't stop printing becomes consensus. That's how you get high or hyperinflation. Not through chaos, but through realization. Let's get back to the interview.
My sense is what will happen is I think we haven't talked about the economy. You see overseas bookings into the United States. You see a lot of indications. I mean, these tariffs are very chaotic, and my sense is a lot of businesses, a lot of individuals, and you see, stock market's down, round numbers. It was down 20%, bounced a little bit. There's a big wealth effect in the United States. I mean, the top 10% own most of the stocks. The top 10% also account for 50% of the spending. When somebody sees their retirement account take a 20% haircut at the margin, they think to themselves, well, don't need that new car, don't need that vacation, don't need that second house, whatever it might be. So, and that filters through the entire economy. And so I believe we're going into an economic downturn. We've juiced the economy for so many years, for so long, that we're going into an economic downturn. And that's going to have all kinds of subsidiary effects. I mean, one is that, tax receipts will go down and social spending will go up. I mean, in 2000 and 2008, when we had those downturns, the deficit went up, to 6 and 9% of GDP respectively. So, it's one hell of a mess. And I think what they're going to be forced into doing is what I call yield curve control, which is to say, and what I keep a close eye on, I keep a very close eye on the price of gold, the price of Bitcoin, silver, all that stuff, and the stock market. The other thing I keep a very close eye on is the 10-year and the 30-year U.S. Treasury, and the Japanese bonds as well. And you can see that the interest rates are in both those areas all those areas are marching up. And I think the 5% is kind of the pain point on the U.S. 10-year. I think if the U.S. 10-year gets to 5%, the Fed's going to say, no mas, we can't have it higher than that. We'll put in some facility we're going to buy 10 years. And how are you going to do that? Well, a mouse click of money, and they're going to put them on their balance sheet, and they're going to put those reserves into the banking system, and the banks can lend against them. And so, that's to me what is a likely next step. It's kind of an industrial financial policy. And a lot of people have actually been talking about that's necessary. I mean, China kind of has industrial national policy, and I'm beginning to think maybe they're trying to, do the same thing, or going to have to do the same thing here in the U.S. I thought it interesting. Basant said he has breakfast once a week with Jay Powell, and my sense is Powell's pretty good at spinning anything the way he wants. I mean, so unemployment will start to get higher. The stock market will be down 25 or 30%. Maybe we'll get a couple of other good inflation prints. I mean, they can usually doctor those a little bit. And then they're going to say, hey, guys, we're really worried about our employment mandate. Inflation's going in the right direction. It's all going to be okay. We need to start cutting rates aggressively, and we need to institute this quantitative easing policy again. And, as if gold and silver and Bitcoin hadn't done well already, at that point in time, everybody's going to go, oh my God, they can never stop printing, can they? I mean, I think a lot of people believed in bonds and believed in stocks because they thought, well, Powell is Volcker and he'll get it all under control. We'll go back to this deflationary trend. COVID was just a nasty blip, and everything will be okay again. And I think that if they're forced into this next pivot, which I think they will be, the psychology will change to, oh my God, they really can't stop, can they? And that's when, if you study high rates of inflation and superinflationary events historically, that's when they occur. They occur when everybody comes to the same conclusion. They cannot stop printing money in the system the way the system is now constructed. And that's what my book really lays out in great detail and tries to show people that is true, and that based on that truth, the way to protect oneself in terms of investing in assets is to own things that the government can't print. The government can't print gold, the government can't print silver, and the government can't print Bitcoin. And so I think those will be three of the best performing assets in the next 5 or 10 years.
LawrenceLepard wraps with a clear warning and a solution. The system is breaking, sovereign debt is unsustainable, and the Fed, cornered by rising rates and slowing growth, will print. Not because they want to, but because they have to. That's why Lepard doesn't recommend trading. He suggests holding what can't be printed: gold, silver, and Bitcoin. These are your escape hatches from the fiat trap. We're heading toward a multipolar world where gold and Bitcoin act as neutral reserves. In that world, those who hold real money will thrive, while the rest will chase after melting assets. Don't be on the wrong side of history. Share your thoughts on LawrenceLepard's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video.